Tom Petrie, you mentioned that you don't see any big change in oil prices until maybe the second half of 2015. What are the characteristics of the companies that are going to be most challenged in the first half?
Clearly, companies that have too much leverage have a problem. Companies that are mostly oil-oriented probably are somewhat disadvantaged in the near term. And companies that still have a lot of spending to do and haven't fully financed how they're going to do it. There are lots of companies that'll come through this fine. This particular downturn so far, I would say there have been enough lessons learned from times past about over-leverage and over-concentration that a lot of the players are going to do fine. But for companies that have not paid attention to those particular factors, it could be a time for consolidation.
All right, so who's going to benefit from all this? Exxon, Chevron, companies such as that?
Well, certainly the downstream operations of those companies will benefit, and that'll be a bit of a cushion for those companies. But their absolute size is a challenge for these companies because they end up running pretty hard to stay in place, at least in the upstream operations. So I'd say they'll get some benefit from the downstream, some benefit from the petrochemicals that'll do all right. But overall, there's probably still more opportunity for companies that can grow absolutely in size. And that includes some producers who are well run.
Well, Tom, let's talk about that. Specifically in certain plays, I wonder if there are certain places where lifting costs have actually come down a little bit as they've figured out how to work certain plays that have been, such as the Bakken and the Eagle Ford and so on. Are there plays that are actually thought to be more expensive than they actually are right now?
Very much so. One of the issues that confuses the issue is that full cost economics don't really dictate how well you do in a period like this, because the sunk cost component may limit your net income. It doesn't cause you to shut in production. And so I think one of the surprises that will come out of this period is people say, wow, production is holding up better than I thought in the U.S. And that's why you see some companies talk about, yes, we're cutting our budgets by 20, 30% in terms of what we'll spend next year, but we're still going to grow absolutely in terms of barrels. And that's the nature of the business, that there's a lag in bringing on production where money was spent last year.
Tom, can you give us a such as? What companies are saying that?
Well, the one company that's talked about it is Continental Resources. They're going to cut by a little over 20%, 25, I think, and they're still talking about a 15 to 20% growth because of the momentum that they have in last year's capital program and the hooking up of those wells. So there's not going to be that much of an effect in 2015 and maybe 2016 on U.S. production. We won't grow as much, but we're definitely not going to drop down very much, in my view.
Tom, equity investors are anticipating a deterioration in earnings for a lot of these energy companies. Credit analysts are worried about the possibility of default. If you look at, for instance, the credit for Quicksilver Resources, its 9.125% bonds due in August of 2019 is yielding almost 60%. A lot of people talk about the risk of default there. Are we going to face a similar situation as in 1986 where there could be real contagion?
I think there'll be selected cases where there could be some contagion, but just some individual reorganizations or forced bankruptcies. And I'm not speaking about the ones you've mentioned because I don't know it well enough to say personally on that. But this is not going to rise to nearly the problem we had in the mid-'80s. In the mid-'80s, there were a lot of companies that were over-levered with bank debt. They were breaking their covenants. And I remember doing some work back then where half the consolidation that occurred were mergers and the other half were bankruptcies. This time I would say it'll be a small double-digit number, 10, 15% that might actually go through a forced reorganization along those lines.
Tom Petrie is a graduate of West Point. I'm wondering if you could talk about the military consequences for the United States foreign policy issues related to the fact that the United States is producing a lot of its own energy.
Well, that's a good point, and the geopolitical aspect of energy production domestically is quite critical. our energy security is much improved, but we are linked to the rest of the world, and that's what part of what the problem is. Some of that Eagle Ford production that we're producing today is now being shipped to eastern Canada under provisions of U.S. law. It's entirely above board. That's backing out West African production, which is now being displaced into Asia and competing head-to-head with Middle East oil. That's a dynamic that we have to work through. That's part of why, while I think we will have some rallies in oil, I think generally it's going to be a bearish environment for multiple quarters before we work through all of that.
Tom, nat gas prices continue to amaze at the low prices. What's your take there on what happens to nat gas over the next 6 months?
I think it gets better, but I think it'll be a second-half event. The reason it gets better is with less drilling of oil projects in 2015, we'll bring on less associated gas from those oil wells. That's been the factor that's kept natural gas supplies growing at a time that we don't have many markets for it. We begin to get a market relief in the second half, probably late third quarter, early fourth quarter, when we start to see the Sabine Pass LNG export terminal open up. And then after that, there's a series of other such LNG export facilities that's going to begin to connect U.S. natural gas to the world market, and that'll, I think, help rebalance things much better than today.
So, Tom, as we look ahead to 2015 and a spate of deal making, what kind of companies do you expect to be purchased, and will that lift the floodgates for more deals to come? I mean, is everyone just waiting for that first deal to be made?
Well, a few have already been made, so I think we've seen the first deal, but I do think it'll pick up some. We've been very quiet in terms of corporate mergers for the last decade, over a decade now. We've been pretty active in rationalizing the ownership of oil fields, of hard assets. But I think the shift is going to go back toward more corporate consolidation. I think it'll be a higher level than it's been. We've typically only had 1 to 3 significant mergers per year for the last 4 or 5 years. And I think that could easily double in pace as you look out to the coming year. Some of those will be under distress, where companies are over-levered and can be bought by a company that's in a better balance sheet position, a fortress balance sheet position, if you will. Also, we're going to get... I'm sorry, go ahead.
No, please continue.
Yeah. The other thing I'd say is I think there's room in the midstream area for consolidation because we need more larger players in that sector. So some combinations of midstream players in this period is something I'd be looking for.
All right, so in the pipelines and transportation companies. Final question to you, Tom Petrie. OPEC clearly no longer calls the shots in the direction of oil prices. Who does call the shots?
Well, the market does, and that's the big concession. Now, at some point, if you start getting global growth again at a more than a pedestrian level, we've had less than 1% growth in some of the key markets. If we get back up to a 3 to 5% or a little better growth, then OPEC could come back in with a seat at the table. But I don't think they ever get to call the shots the way they did sometimes in times past. But I think it's in everyone's interest to have a working price that works for the producers and the exporters and also works for the consumers. My judgment, that's a $60 to $80 barrel price in real terms, so it'll move up over time with inflation, but not back to 100 plus for some time yet to come.